In today's video, I will teach you how Warren Buffett picks stocks using fundamental analysis. I will explain fundamental analysis. Knock down into pieces. Warren Buffett metrics of fundamental analysis: economic moat, financial health, management, quality industry position, macroeconomic factors, margin of safety. Warren Buffett did not become an investing legend by luck. The Oracle of Omaha has a secret weapon: fundamental analysis. Buffett doesn't buy stocks, he buys businesses. Imagine you want to buy a used car. You did check the engine, test drive it. Buffett does the same with stock, but instead of a car manual, he uses fundamental analysis. What is fundamental analysis? Warren Buffett's approach to fundamental analysis revolves around determining the intrinsic value of a company by thoroughly evaluating both quantitative and qualitative factors. What is intrinsic value? It is estimating the true worth of a business based on its ability to generate cash flows over the long term, discounted to present value. Buffett focuses on future earnings potential rather than short-term market fluctuations. Key elements of his methodology include economic moat. Warren Buffett's concept of an economic moat is central to his legendary investing success. Imagine a medieval castle surrounded by a deep, crocodile-infested moat. This vivid metaphor captures how companies with sustainable competitive advantages protect their profits and market share from rivals. Let us dive into Buffett's key economic moats and why they're critical for long-term wealth creation. The 5 pillars of Buffett's economic moats. Cost advantage. The price warrior. Companies that produce goods or services at a lower cost than rivals can undercut prices or enjoy fatter margins. Buffett loves businesses like Geico, which bypasses agents to offer cheaper insurance, and Costco, whose bulk buying model crushes competitors. The brand magician. Powerful brands, patents, or licenses create loyalty and pricing power. Coca-Cola's iconic status lets it charge premium prices globally, while Apple's brand loyalty turns customers into lifelong devotees. Buffett calls these castles with moats filled by perceived virtues in consumers' minds. Network effects. The snowball effect. The more users a product has, the more valuable it becomes. Think Amazon, dominant e-commerce network, or Visa, ubiquitous payment platform. Competitors struggle to replicate these ecosystems, creating self-reinforcing advantages. Switching costs. The invisible handcuffs. When leaving a product is costly or inconvenient, customers stay loyal. Microsoft's Office suite embeds itself in workflows, making switching to alternatives like Google Workspace a hassle. Buffett seeks businesses where the moat is the pain of leaving. Efficient scale. The big fish dominating a niche market, like utilities, or achieving economies of scale, e.g. Walmart's supply chain, creates barriers. Smaller rivals can't match the efficiency, ensuring the big fish keeps growing. Financial health. Warren Buffett doesn't just pick stocks, he hunts for financial fortresses. His approach to financial health is like a detective inspecting a company's DNA to ensure it's built to survive recessions, outlast competitors, and grow for decades. Buffett's obsession with financial health boils down to avoiding disasters. He once said, "Rule number 1, never lose money. Rule number 2, never forget. Rule number 1. Buffett's 5 financial health superpowers. The balance sheet. Debt is the enemy. Buffett hates companies drowning in debt. His checklist: low debt-to-equity ratio of 0.5 or less. Like a person with minimal credit card debt, healthy companies don't gamble with borrowed money. Ample cash reserves. Cash equals oxygen. Think about Apple, sitting on cash to weather storms or seize opportunities. Buffett's rule: if a company needs constant debt refinancing, run. Earnings consistency. The steady Eddie test. Buffett adores businesses that print money predictably, like See's Candies, earning profits for 50-plus years. He asks, are profits growing smoothly over 10-plus years? Are earnings volatile like airlines or reliable like toothpaste brands? Return on equity ROE. The profit engine. ROE measures how well a company uses shareholders' money to generate profits. Buffett wants ROE 15% consistently. Coca-Cola, ROE 40%. Brand power equals profit machine. Key insight: high ROE plus low debt equals a business that's efficient and resilient. Free cash flow. The golden goose. Buffett calls free cash flow the gold standard because it's the cash left after expenses, money that can be reinvested or returned to shareholders. Microsoft, $60+ billion annual FCF funds, dividends, buybacks, and innovation. Bad businesses. Negative FCF equals burning cash, e.g. unprofitable tech startups. Buffett's wisdom: cash is to a business as oxygen is to an individual. Margins, the fat and happy rule. Buffett loves high profit margins, gross operating and net. They signal pricing power and efficiency. Moody's, 50% net margins. Credit ratings equals high moat monopoly. Walmart, thin margins but offset by massive scale. Watch out, shrinking margins equals moat erosion, e.g. retailers versus Amazon. Management quality. Warren Buffett doesn't just invest in companies, he invests in people. For him, great management is the secret sauce that turns good businesses into unstoppable empires. The 5 superpowers of Buffett-approved management integrity. Buffett's rule. Look for 3 qualities: integrity, intelligence, and energy. If they don't have the first, the other 2 will kill you. Capital allocation genius, the money whisperer. Buffett loves managers who avoid dumb acquisitions. No overpaying for synergies. Looking at you, Kraft Heinz. Buy back shares when undervalued, like Apple's 600B plus buybacks. Pay dividends only if they can't reinvest at high returns, e.g. Coca-Cola. Long-term goggles. Buffett hates leaders who obsess over 90-day earnings to please Wall Street. Buffett's take. Someone's sitting in the shade today because someone planted a tree a long time ago. Stewardship greater than ego. No empire building. Buffett avoids CEOs who chase size over profitability. Skin in the game. The ownership test. Buffett wants leaders with major personal stakes in the company. Industry position. Warren Buffett doesn't just pick stocks, he diagnoses industries like a financial doctor. His approach to industry metrics is all about spotting durable profit pools and avoiding sectors where even genius management can't save a sinking company. Buffett's 6 industry supermetrics. The growth galaxy. Steady demand over hype. Buffett loves industries with predictable, evergreen demand. Think toothpaste, insurance, or candy. Hello, C's Candies. Key questions. Does the industry sell needs or wants? Medicine versus luxury handbags. Is demand growing slowly and steadily, like utilities, or collapsing, like malls? Buffett's pick. Coca-Cola. People will always drink sugar water. The moat matrix. Barriers to entry. Industries with high barriers crush competitors. Buffett looks for. Buffett's rule. Avoid industries where every idiot with a checkbook can compete. The profit oasis. Fat and stable margins. Buffett obsesses over industries where companies print money consistently. Metrics to watch. Average industry ROE, return on equity, 15% equals sweet spot. Pricing power. Can companies raise prices without losing customers? Example, Apple in premium tech. The cannibal test. Innovation versus obsolescence. Is the industry being disrupted? Buffett avoids sectors where tech could erase moats. Print media versus digital news. Traditional autos versus electric vehicles. The cycle shield, resistance to booms to busts. Buffett prefers non-cyclical industries, aka recession-proof, consumer staples, toilet paper, toothpaste. Healthcare, people get sick in any economy. Avoid luxury goods, travel, or commodities, like oil, they swing wildly with the economy. The regulation roulette, friend or foe? Some industries thrive under regulation, e.g. utilities, while others get crushed. Buffett asks, is regulation predictable? Insurance equals yes. Does it protect incumbents? Railroads equals yes. Could sudden rules destroy profits? Cryptocurrency equals yes. Macroeconomic factors. Warren Buffett incorporates macroeconomic factors into his fundamental analysis to assess the broader economic environment and its impact on potential investments. Interest rates. High rates act like gravity on valuations, lowering the present value of future cash flows. Inflation erodes purchasing power. Buffett seeks businesses with pricing power that can raise prices without losing customers. Economic growth. Strong GDP growth underpins corporate earnings. Buffett endorses the market cap to GDP. Buffett indicator as a top valuation gauge. Monetary and fiscal policy. Prefers stable, predictable policies. Evaluates effects of tax changes and stimulus, and has warned of potential tax hikes to rein in deficits. Currency fluctuations. A strong dollar can hurt exporters. Buffett monitors forex risk, favoring firms with natural currency diversification or effective hedging. Margin of safety. Warren Buffett's margin of safety isn't just a strategy, it's his golden rule for surviving market roller coasters without puking your portfolio. Buffett compares investing to building a bridge. If you're building a bridge that can hold 30,000 pounds, you make sure it can hold 50,000. That extra 20,000 is your margin of safety. In investing, buy stocks priced way below their true worth, intrinsic value. This buffer protects you from calculation errors. Oops, your intrinsic value math was off. Black swan events, pandemics, inflation, alien invasions. Market insanity, when meme stocks or cryptomania hijack rationality. It's a mindset. The Buffett formula. How to calculate your sleep well. Discount Buffett's margin of safety isn't a precise number. It's a mindset. Here's how he applies it. Estimate intrinsic value. Use discounted cash flow, DCF, or compare to stable peers. Demand a discount. Buy at 50 to 70% of that value. Profit. Wait for the market to catch up or collect dividends while you wait. Example. Coca-Cola's intrinsic value in 1988, $40 per share. Buffett's buy price, $25 share, a 37% discount. Result. A 1,500% plus return over 30 years. That is Warren Buffett's approach to fundamental analysis. It is not just a strategy. It is a philosophy rooted in patience, discipline, and an unshakable focus on value over noise. Like a master architect, Buffett constructs portfolios with businesses that are built to last, not just to dazzle Warren. Now, here's what to do next. Hit like if you found this helpful, subscribe for more investing tips, and ring that bell so you never miss an update. Have questions or want us to dive deeper into any topic? Drop a comment below.